I mean, do you mess with margin at all, or is that something you tend to stay away from?
I did back in the day. This was like, 2014. I got into some margin in 2015, and it went really bad, really, really bad because, the thing about margin that's very addictive is you see it there in your portfolio, and then let's say stocks start going down. You're like, oh, let me just buy a little bit on margin. And then you're like, let me buy a little bit more on margin. And then you're like, let me buy. And next thing you know, all of a sudden you're in a situation where your stocks are getting close to margin calls, and then something goes wrong. The market freaks out. And next thing you know, you got a margin call, and then you're like, oh my gosh, I have to sell this stock I love at such a bad price. Like this is, and so margin, what I would say for folks is stay away from it. I have my account set up for margin, so that way I don't need my money to clear. I can invest it right away. It doesn't need like the 3 to 5 days. But in terms of like the public account, for instance, I could do $1.7 million of margin. I have $0 on margin in the public account, and I have no plans to margin that one out. Is too stressful, man. Way too stressful. As a long term investor, it's very alluring, but no, no, no.
Yeah, that's exactly it, man. I'll get comments sometimes not too often, but every now and again I'll get comments from probably beginner investors because that's typically where my audience skews. And some of them will say that they borrowed some money to invest in stocks just like as they're just starting out too, just kind of wanting to rush things, build up especially for dividends, get cash flow super quickly, and they'll always like 9 times out of 10 they'll end up putting that into something like a covered call ETF like a JEPI or QYLD, or we're seeing even now, I don't know how much you keep up with this stuff, but the yield max ETFs, are you familiar with those at all?
I have never invested in any of those before.
So these yield max ETFs specifically are basically the fund will write call options. I guess they're called synthetic call options on stocks like Tesla. There's one for Apple. There's one for Amazon, Berkshire Hathaway. And they're yielding something like 30, 40, 50% sometimes in terms of the dividend yield. And they just came out too like a few months ago. But I've seen a lot of people pile money into stuff like this. And I've gotten a couple comments. Luckily, it's not been a lot. And hopefully I don't get any more of people taking margin to buy those sort of things. And I don't know, I can't help but think that's just a terrible move, especially for someone just getting going.
Yeah, 100%. Yeah, even if you're sophisticated, it's a problem, and you've been in the market a while. In taking myself back to that story from me from kind of like 2014, 2015, for me, I got great returns for many years in a row because I started 08, 09 investing, and then
Yeah.
2010 I killed it, 11, 12, 13. And so for me, it was just like, oh man, look at these returns I'm getting. Look at how much money I'm making. Only I had even more money to invest. And that's
Yeah.
where you start thinking margin.
Right.
And yeah, yeah. Even if you're sophisticated, it's not worth it, and you've been in the market a long time, but especially if you're newer, it's just, yeah, it's usually going to end bad. It's just a question of how long does it take to end bad? Like 6 months, 12 months, or like 24 months.
Yeah, absolutely, man. And kind of on that note, like take me all the way back to the beginning. Is just as far as investing, how did you even get into this stuff in the first place, and what made you think like this is something that I need to be doing?
Yeah. So with me, I mean, it really started kind of around college, when I went to community college, and I had I was at that time I was really still trying to figure out like where I was going in life. Like I didn't have it all figured out. Certainly, this is like 2008, 2009, and I had a really good accounting teacher, and he was actually a gold bug. But what he loved to show us a lot of times in accounting class, he would like before class kind of started and got rolling, he would just show us different things and give us kind of different perspectives, outside of just basic level accounting. And he used to show us, compounding and, how much your money could compound and suggest like play around with a compounding calculator sometime. And I just remember like how fascinated I was just seeing like the growth numbers as the years tick on. And if you get this sort of return, how much this adds up to, and you deposit this much money in your account. And just like, that's what really got, in at that time, I'm like 18, 19 years old. So I'm like, oh my gosh, like this is a game of time, staying invested, being long term. And it was just fascinating to me. And then I was kind of a little lost for a little bit there in terms of like what I was going to do, how my approach is going to be. So I'd watch CNBC and things like that, and I'd watch like Jim Cramer and stuff. But then one day I saw Warren Buffett, and like that changed everything for me. Like you're just hearing him talk, and learning a story, and then I would find YouTube clips. This is like, in the computer lab in like 2009, and just old clips that people would record of Buffett, and different things, speeches he would give to college students and stuff. And I just like that really what set me on the right track to kind of being a long-term investor. I started out as just value and dividend stocks only. If it was over a 20 forward P, don't talk to me. Like it's got to be super low PE.
Yeah.
It's got to be, my first investments were simplest businesses like Walgreens, Walmart, Conagra Foods, Kimberly Clark, like some of these sorts of companies back in those days. But anyway, so that's really how my journey started, and it was just a fascinating time. The bad thing back then, the youngins you guys don't get this, okay? But back then, 1995 per trade you did, 1995 every time you bought and sold a stock. And for me, I'm investing a few $100 a time. So it's like, oh my gosh, like it's a $20 commission to buy $300 worth of stocks. Like this is ridiculous. So, but thank goodness, very shortly after they brought it down to $9.95. Then they brought it down to $4.95. I'm talking about Fidelity Investments, and then probably 5-7 years ago they went to $0 because of Robinhood. So thank you, Robinhood, for that. But and we can all thank Robinhood. I know Robinhood always gets a lot of hate, but Robinhood definitely changed the game when it came to $0. But yeah, that's my journey. And then just got into some stocks over time that really changed the game for me. Trinity Industries was a company. This was a company that was a rail car operator. And what I saw was there was this big fracking boom going on in like North Dakota, kind of like South Dakota region. And I was like, oh my gosh, you got to transport all this oil around and whatnot. And so Trinity Industry made the rail cars, that are specifically for that industry. And so, I just was like, this is going to be a booming industry for a long time to go in the future. And Trinity Industry stock just was a beast. And so I capitalized on that. Monster Beverage was one of my first growth stocks. That really
killer company.
Yeah. Yeah, and I got that one because I worked at Quick Trip as a overnight assistant manager. I got a job there end of 2010, and all these landscapers and guys would come in buy 2 Monsters a time. And I'm like, back then I wasn't really familiar with Monster, and I started looking in the company. I found it was a public company, and I remember when I bought Monster, the forward P on it was probably either high 20s or low 30s, I think. And for me, that was like really risky because like my mindset is like, I want a forward P of 10, 15, something low. And so to pay up for a stock like that, that's what kind of was like my gateway drug of like getting into growth stock investing. And then Cabela's was a phenomenal one for me. Cabela's, which is the outdoor store, they went through a massive kind of boom that just, since the time I got in that stock, it just went up in almost a straight line. It was a beautiful, beautiful thing. They were expanding stores. There was a huge gun boom, an ammo boom that went on. Specifically around this like 2012, 2013, it was just like mayhem. You'd go into the gun section at Cabela's in those days, and it was just jam packed. It was like a can of sardines. Everybody was afraid the government was going to stop everybody from buying guns, and there was that worries. And yeah, so anyways, that's kind of some of my early day journeys, and some fun ones nonetheless.
So those couple examples or instances where you probably saw really tremendous gains, that kind of changed your perspective on your whole approach to investing. That's kind of what sparked the evolution from being a strictly dividend investor, low PE, to realizing there may be more beyond that. Is that kind of what happened?
Yeah, and that kind of led me to the thought process of it's more than just what did the company earn last year. And you rather really start running projections on stocks and trying to figure out, okay, where's this company's revenues likely headed next year? What about the following year? What about the following year? In order to try to project out that and then try to figure out, okay, what's the realistic gross margins for this company? What's the realistic operating margins? What's the realistic net income? You got to really go down that rabbit hole deep into that company and really, and still you're going to be wrong sometimes. So it's never like it's a foolproof 100%. You're going to be right. You're always going to miss some, here and there. But yeah, and then learning to run projections on stocks and then trying to figure out, okay, if I'm paying a 30 forward P for a stock, it looks maybe expensive because the market trades at, let's say, a 20 or 15 or whatever, but it might be a steal deal if this company is going to eat up the profitability over the next few years. And next thing you know, actually the following year, it's actually trading at a 20 forward P based upon next year numbers, or a 12 on the following year or something like that. And that's where you get into this kind of like thought process of like, oh, like Amazon's a perfect example. I remember looking at Amazon like 2010, 2011 and being like, I love this company. Like, I think everybody's going to be ordering packages in the future, and this AWS thing that seems interesting. But I couldn't buy Amazon because the PE, it was so dang high. But if I knew at that time to be able to run projections and things like that, I would have been able to easily buy Amazon stocks. I would have been like, oh, they're gonna eat this up. They're gonna get to this sort of EPS in future years and things like that. So that's a hard process to do, and that's one of the more complicated things.
Yeah.
It's much better to start as a value dividend investor because it's so much easier of a game. You can look at
Right.
Coca-Cola and it's got a certain amount of income over the last many years. You can figure out where it's likely going to grow next year. You can look at the forward P and you can say, yeah, this is a fair valuation I'm paying as a fair price or not. So some of those companies are much better for beginners. Beginners, sometimes these folks like to get in like crazy stocks, and it's like, I'm just saying, like, you're not at the level yet to really understand how to run valuations out for future years on companies and all those sorts of things. So
And
what
that's
you're doing is really good for beginners, in my opinion. Really, really good.
Oh, well, thank you, man. And some of the crazy stuff that people get into when first starting out, which, by the way, is something I fell victim to as well. It's a combination, I think, number one, of human psychology. People just want explosive gains. They want overnight things. Understandable, especially in today's day and age where everything's so immediate. But also, it's probably partly as a result of, which this is a good and maybe a not so good thing, just partly a result of there just being so much information out there, so many people talking about stocks, and which could be good because it helps build awareness and can get people into investing. But if you watch the wrong video or listen to the wrong podcast or read the wrong article, it could put you down a pretty bad direction that could ruin investing for you potentially. So yeah, man, it's like I said, it's kind of the double-edged sword of being an investor today. It's good because we've got access to so much information, like you were saying earlier, commission-free trading. Now there's really no barrier to entry to getting in and starting to do this, which, I firmly believe that investing in whatever capacity, whether it's real estate or stocks or however which way you want to do it, is something that everyone has to do. As the old Warren Buffett quote goes, if you don't find a way to make money in your sleep, you're going to work until you die, and no one wants to do that. So you better get started soon and figure it out.